Welcome back everyone, this side Mayank Kothari. This is the last lecture of the fast track batch and I hope you have enjoyed with me till now for the entire strategic financial management subject. This is the last lecture in which we are going to discuss about the two questions from the startup finance chapter, which are pretty much easy, and then we are going to discuss something about the tips for the strategic financial management paper in your exam. So this is going to be an interesting thing. Please attend the entire lecture and then you can be on your way for preparing the subject. Let's have a look on the first question, sir. Startup finance. See, first of all, the startup finance is more of a theory chapter, and 99% chances are there that only theory will be asked from this chapter. So these two questions that I am considering right now, consider it as only additional part of the startup finance. This is the question which is included in the study material of the institute, and that's why we are considering this. Have a look. This is the first question. This question is from ICI study material with incomplete information, only for the class discussion. So couple of information that I have taken like from the answer itself. Let's have a look. X is a small software company that is providing a niche data control and testing service having 60 employees and some steady contracts. So this is a company with a 60 employees and some good revenue in their hand, which generates an EBITDA of 100 lakhs per year, 1 crore of the profit every year. A venture capitalist convinces the managing director of the company to sell off the majority stake to him, valued at a premium of 100% per share over the book value, plus one-time goodwill payoff of rupees 50 lakh. So there is one venture capitalist who wants to buy majority stake in this company having EBITDA of 100 lakhs per year. And he is ready to pay, the valuation is at a premium of 100%. That means double the book value. Whatever is the book value, he is ready to pay double of that. So premium of 100% per share over the book value plus one-time goodwill payoff of 50 lakh using the income-based valuation approach. Thus, the total consideration comes out to be 250 lakhs. So they have not given you the book value, but they have given you the total consideration. So whatever is the book value, you are going to add 100% premium to that, plus add 50 lakhs, and it should become 250. So in that case, this has to be, if we go by the reverse calculation, this should be 200 lakhs and this should be 100 lakhs. So 100 plus 100% is 200 plus 50 of the goodwill will be 250 lakhs. Next, the venture capital ropes a banker to pump in 200 lakhs for the acquisition cum expansion. See, venture capital does not have this much of the money, this 250 lakhs. He is ready to buy the majority stake of the company at this much of the price, 250 lakhs, but he doesn't have this much of the money. So he has gone to the banker and he has convinced the banker to give a loan of 200 lakhs for the acquisition cum expansion plan, as to do the brand marketing, thereby making the company a visible player in the market. Now, the gap of rupees 50 lakhs, see, 250 lakhs is the valuation, 200 lakhs will be given as a loan by the bank, and the balance 50 lakh will be given by the given as his contribution as a promoter. So venture capitalist will become a promoter to this company. Okay, equity towards securities premium. Since the core operation team is not dismantled, so what is happening? The venture capitalist is investing in this company 250 lakh rupees, but the operational part, that is the employees, 60 employees are still there in the company running this company. Okay, the company easily achieves a 20% average growth in each of the next 3 years. Right now, the 100 lakhs is the total profit right now. Okay, so next year it will achieve EBITDA of 120, then plus 20% 144, plus 20% 172.8. So this is how the EBITDA will be for the next 3 years. At the end of the third year, understand, the venture capitalist puts the company on sale block and is able to garner interest of leading multinational companies in the same. Assume if the exit multiple that the venture capitalist looks is at 7 times the EBITDA, earning before depreciation but after tax. Now, what is happening? This person, venture capitalist, has bought the company today, and after 3 years of successful operation, he is now ready to sell this company to the market. And the valuation that he has put is 7 times the EBITDA after taxes profit, 7 times of the after taxes profit. Okay, there are a couple of things that you should note. Interest rate is 18%. So instead of 8%, please make it 18% in your book. It's not 8%, that's a printing mistake. Now the principal is repaid in 6 years linearly. Try to understand. Principal is repaid in 6 years linearly. That means 200 divided 200 lakhs rupees of the loan was taken, divided by 6. Every year we are going to make a repayment of 33.33 lakhs. So 1, 2, 3, 4, 5, 6. What will be the opening balance? Opening balance every year on which the interest will be charged. For the first year 200, then 166.67, then 133.33, then 100, then 66.67, then 33.33. The closing balance here will be 0, because you will make the principal repayment of 33.33 at the end of the 6th year. This is just the opening balance of every year on which the interest will be charged. So first year, second year and third year, we are going to just calculate this much of the interest, which comes to 36, 24 and 18 lakhs. 36, 20, 36, 30, sorry. It will be 36, 30 and 24 lakhs. And at the end of the third year, the principal balance is 100 lakhs left in the company, still repayable, 100 lakhs of the debt. Okay, sir. Now, tax rate is 30%. Calculate the value of entity value of the company. Very simple, sir. Let's first take the EBITDA. EBITDA, earning before interest, depreciation, tax and amortization. We are increasing that by 20% every year. So this is 178. 178 for the third year. Now there is slight mistake in the study material by the institute that the interest of the first year is taken at the 0th year. So nobody pays interest at the 0th time, right? So 36 has to come in the first year. So it will come here, it will come here and it will come here. So 18 will not be there. It will be 24. So I'm just writing the third year column once again. 178 minus 24 will give you 154, on which we are going to pay 30% tax, which will become 46.2. So 154 minus 46.2 will give you 107.8. Multiple of 7 will be used. Now we have reached at the earning before depreciation, amortization, before depreciation and amortization, but after tax. Now EBITDA, the question clearly says that the venture capital wants to sell this company at a multiple of 7 at the end of the year 3, and at the end of year 3 the EBITDA is 107.8. so what will be the value? 107.8 into 7 comes to 754.6. But try to understand, in this company 100 lakhs of debt is still pending for the payment. So the net equity value is this. If you want to calculate the equity value, 654.60 should be taken and you can sell the entire equity that you are holding. And if you want to calculate the value of the firm, then it's 754.60. So there are two answers. It all depends upon what exactly you want to calculate. The equity value of the company is 654.60. Firm value is 754.60, because at the end of the third year, 100 lakhs of the debt is still pending to be paid, which will be paid linearly in the next 3 years. This is the question of earnings capitalization method. Now try to understand. Earnings capitalization method. You have solved such type of questions in the past as well. In that you had to divide the profit after tax with cost of equity. But tell me, cost of equity is the inverse of P ratio, right? and multiple is nothing but the PE ratio. So if you divide the profit after tax by cost of equity or you multiply it with the PE ratio, you will get the same answer. So earnings multiple method or earnings capitalization method, both will give you the same answer. So this is how we have calculated the value of the company in this question. In the next page you can clearly see we have deducted 100. So slight variation in the answer because of the interest rate mistake that we are going to correct in the next edition. Please do the correction in your copy as well. Okay, sir. Let's come to the second question now. Quite interesting. TMC is a venture capital financer. It received a proposal for financing requiring an investment of 45 crore which returns 600 crore after 6 years if succeeds. See, this is a venture capital financer. Someone reached out to the venture capitalist and they said that we have a funding requirement of 45 crore today. So if you invest 45 crore today, we will be able to give you 600 crore at the end of 6 years, provided the project is successful at the end of 6 years. That means provided this project survives till the end of 6 years. If it gets failed between the 6 years or before 6 years, then this return will not be possible. However, it may be possible that the project may fail at any time during the 6 years. So if I am the venture capitalist, I have to take that risk that if I invest 45 crore in this project and if the project fails in between, I will lose the entire 45 crore rupees. But if the project is able to survive for the next 6 years, then I can have a massive gain, which is of the total cash flow at the end of the 6th year will be 600 crores if the project survives. The following table provides the estimate of the probabilities of the failure of this project. See, first year the probability of failure is 28%. So can I say the probability of success is 72%? Every year there will be only two probabilities, one for the failure, one for the success. If the failure probability is 28%, the successful probability will be 72%. In the second year, the probability that the project will fail is 25%. It will succeed is 75%. It will succeed is 78, 82, 82 and 90%. So probability of failure is given, but we have calculated the probability of success as well. Now try to understand. The project can fail in the second year only if it has survived through the first year. Try to understand this logic. It cannot fail in the first and the second year at the same time. It has to survive in the first year in order to fail in the second year. It has to survive through both the years in order to fail in the third year. It has to survive through all the 3 years if it has to fail in the fourth year. So every failure probability comes with the fact that it has survived in the previous years. Okay, sir. What is the probability that the project will be successful in all the years? See, now the outcome which is possible. Can I say that project will fail every year? No, this is not logical. Nobody can die every year. If you have to die, you will be dying in any 1 year out of 6. And if you are dying in the 6th year, that means you have survived through 5 years. So I cannot say that what is the probability of failing in all the 6 years. No, you cannot calculate such a probability because such logic does not exist. It is as good as saying what is the probability that you will die every year. No one dies every year, right? But yes, I can say that what is the probability that the project will survive through 6 years. All the 6 years. Yes, I can calculate the probability. It is as good as asking that what is the probability that you will be alive through all the 6 years. You can be alive here as well, here as well, here, and here. We can live through the 6 years, but we cannot die every year. We can live every year, but we cannot die every year. So, what is the probability that the project will be successful in 6 years? In all of the years, multiply this probability. You will have to calculate a joint probability. Keep multiplying every probability with the next year and you will get the desired result. 0.72 multiplied by 0.75 multiplied by this, multiplied by this, multiplied by this. So simply saying 0.72 into 0.75 into 0.78 into 0.82 into 0.82 into 0.90. That comes to 0.255. That is 25.5% is the probability that your project will be successful. And the balance is the probability, that is 74.50% is the probability that your project will fail in any of the year. Not through all the years, in any of the year. 74.50% probability that your project will fail in, let's say, in 6th year, in any of the years, or in the 6th year, 5th year, 4th year, anything. So that's the probability. Now, in the above table, the probability that the project fails in the 2nd year is given that it has survived through the 1st year and similarly from year 2 onwards. TMC is considering an equity investment project. The beta of this project is 7, market return is 8%, risk-free return is 6%. What is the cost of equity? 6% plus 7 is the beta, 8 minus 6. 6 plus 14, that's 20% is the cost of equity. This is what the return required to you. You are required to compute the expected NPV of the venture capital project and advise the TMC. Very simple, sir. This is one thing which will happen today. 45 crore you are going to invest. So, there will be two things here. You will gain 600 crore or you will gain nothing. Right? So, what is the probability that your project will be successful? It's only 25.5%. 25.5% is the probability that your project will be successful and 74.5% is the probability that you will get nothing at time 0. So if you calculate the expected value, it comes to 153 and 0. So the total is 153 at 100% value. So on an average, if you invest 45 crore today, in 6 years time, you will get 153. The expected value of the cash inflow at the end of 6 years. Although it says that you are going to get 600 crore, but the probability of that is only 25.50%. You will get the 600 crore only if the project survives through all the 6 years, right? 1, 2, 3, 4, 5 and 6. And the probability of that is only 25.50%. So the expected value, you remember the value of the call option and put option. So CU, CD, then we used to multiply the probability. It's just like that. If the option is exercised, you will get 600. Otherwise, you will get nothing. So 153 is the expected value. Now, the only thing that you have to do is you have to bring back this cash inflow. Bring this cash inflow to time 0. So this is your cash outflow. This will be your cash inflow. This will be your present value, NPV. So you will divide it by 1 divided by 1.20 to the power 6. 6 years present value factor. 1, 2, 3, 4, 5, 6. That's 0.335. It comes to 51.255. See, 51.255. That's it. The total investment today is 45 crore. The total present value, and that too the expected present value of the cash inflow that I am going to receive at the end of 6th year is 51.255, and the NPV is coming to 6.255. That's it. You won. NPV is positive. You should accept the project. Have a look. The institute has a different advice TMC. Accept the project. Institute has a different approach of calculating the same, but it is coming to the same conclusion. See, 25.5% is the probability that the project will survive, and 6.255 is the net answer. But I can tell you one thing, you can avoid so much of the calculation. You can simply write it in this manner: NPV is equal to present value of cash inflow minus present value of cash outflow. Expected value of cash inflow at 6th year is very simple, sir. Either you will receive 600 crore or you will receive 0. 25.50% and 74.50%. I will just take all these figures here. 153 0 153. That's it. So 153 into present value factor is how much? 0.335. This will be your present value of cash inflow minus 45 crore. 51.255 minus 45. That's 6.255. That's it. When you can finish the answer in a simple format, why to just confuse yourself with so much of the details? So this is your answer. You can just finish this, and we are at the end of the chapter. So with this we have finished. How many questions, sir? Let me just go through it. See, we have almost finished around 637 practical questions. Way too much for fast track batch, and I'm very happy that we have covered so many type of questions. Obviously the repeated ones were given as homework. Out of this, I can say around 137 maximum questions we might have given as an homework, but 500 practical questions were at least I think we have discussed in the class. 309 theory questions are there. Don't ignore the theory. You have to read it. And how to go with the theory? It's very simple, sir. Theory has to be given multiple readings. So at least 3 times you have to read the entire module. The module, you can have a reading on the 3rd volume that we have given, or you can go through the institute's study material also for the same, and it will give you a good edge, and it will make sure that you are clearing the exam. So theory is something which you can take the benefit out of it. But yeah, obviously I understand that theory, most of the students do not give the importance to the theory, but those who will be able to do exactly opposite of what most of the students are doing will also get the result of exactly opposite that most of the students are going to get. So you have to be different. Focus every time on what others will be studying, like how others will be studying this subject and how better I can do it from them. So if you can just do it better than the average person, now you will get through the syllabus and you will get through the subject in the exam as well. So that's it. This is your end of the fast track batch, sir. Couple of things that I want to discuss with you is, please focus from the theory and practical point of view. I will tell you from the theory and practical point of view, the important chapters are like this. You can mark it in your weightage sheet. I will just remove this data, and from the theory and practical perspective. So this theory of 4 marks is confirmed, and I'm asking you to mark like important ones. Means in a short period of time, if you want to cover maximum marks, this is what the marking will be like. This is what is going to be useful. This theory of 4 marks can be easily scored because the chapter is very small. This practical of 8 marks can be easily scored because the chapter is very small. Okay, after that I will just shift to this theory of 4 marks and this practical of 8 marks. Securitization is very easy. Mutual funds is also a small chapter. It doesn't have a lot of varieties. We can easily score 8 marks out of it. After that, if I just shift to corporate valuation, very easy chapter with 8 marks of practical part, and then the startup finance with theory of 4 marks. Even I should include the mergers and acquisition, but I'm skipping it right now. So all in all, if you will see, we have a theory of 12 marks and the practical of 24 marks. In total, 36 marks of the question are very easy to score. Easy. Like it will only take 20% of the time as compared to all the other chapters. So if 100% of the time is required, let's say for example, if 100 hours is required to prepare the entire SFM, you can score 36 marks of the question in 20 hours only. So this covers 20% of the time, and 80% of the time will need 120 minus 36 around to solve 84 marks of question. In total, I think the questions will be of 120 marks in the exam. It depends upon you how you can do it. But I will tell you one thing, this is the easiest part that I have told you. But obviously what will happen, you will be able to solve some questions from security, portfolio, forex, derivatives, mergers. You will easily get 30 marks out of all these chapters because a lot of questions will be asked from these chapters. So try to understand, scoring 60 marks is not that difficult in SFM. The good part, the only part which is required is the smart analysis. You should, out of 14 chapters, you should make sure that these chapters that I have marked right now should be very, very strong. And it requires a minimum amount, like minimum time of yours. So what you can do is you can focus on making these chapters very strong, and then rest of the chapters a normal study. So 36 marks from here and around 30 marks from the rest of the chapters. Easily you can score 66 marks. And those who are going good with the other chapters as well, please try to understand, if you are good at any of the other chapters which I have not marked, it's a bonus. You can score more than 70 marks in exam. So that's it. This is what you need to understand. This is how preparation has to be done. It happens at everywhere. This is a common sense. At Conferenza also we have around 500 products listed, but only 50 products, or we can say only 25 to 30 products constitute 80% of the sales. At Amazon also this happens. And at any places, like at most of the places this happens, that low number of products, a few number of products will constitute majority of the revenue, and other products will constitute lower percentage of revenue. So you focus on those few products which can easily get to the majority of the revenue, that means majority of the score. So this is how you have to study. This is very, very important. Our compiler includes everything. So you should not go, there is no need to go beyond this compiler. This is updated till May 22. You just have to consider the May 22 suggested answer, because by the time of printing of this compiler, suggested answers of May 22 were not declared. Okay, the second thing is you can access the ebook of this compiler in the Conferenza app as well. If you have taken the fast track batch, so you can access the fast track batch in the Android app as well. So those who are taking Google Drive and pen drive lectures can access the lectures in the Android app as well. That's it. This is the end of the story. Stay connected to the Telegram channel and YouTube of CA Mayank Kothari so that you get updated for your exams all the time. This is not the end, sir. I am connected with you on the Telegram and YouTube as well. If there is any problem that you face regarding the classes, you can mail at support@conferenza.in to get the help. And if you like the lectures and if you really want to support me, please make sure that you are buying all your classes and all the books that you need from conferenza.in itself. It helps me to grow and make a good decision and implement new things for the students. Whatever I'm earning from the website, I'm investing back in creating some good apps, creating some good services to the students. So yeah, a portion of that goes to the benefit of the students, a portion of that goes to the household of the employees, and that the rest of the part goes to me. So that is what the strategic financial management is. I hope you have liked all the classes, like all the chapters classes. For now, I'm saying just bye bye. All the best for your exams.